9. Envision and create your masterpiece. Remember that happiness is a decision, not a result. Dan Sullivan. In this chapter, I will provide you with ideas about creating and implementing your business legacy that is in alignment with your values. Most business owners do not have a clear vision as to when and how they should create a family business legacy. Therefore, they often wait until it is too late, and they end up paying an enormous amount of money on taxes. Creating the right foundation for your family business legacy is a long-term project based on the values of the entrepreneur and allowing space for each generation to find their passion. Accordingly, each family member must earn their place within the organization and needs to be compensated accordingly, either with tangible or intangible benefits. One of the entrepreneur's delicate tasks is to regularly apply the family values and to properly train each generation according to their passions and talents, and within the organization's mission and vision. In the process of writing this book, I contacted some of my global Harvard Business School friends and classmates, and my research shows that some of the Harvard Business School Owner-President Management, OPM graduates, have decided to give away a percentage of their company ownership to their children during life and teach their children how to be responsible for what they receive now and could receive in the future. These business owners felt that giving during life makes their children legally responsible and desire to do the right things for the organization and for themselves to preserve a family business legacy. Another important factor is that these business owners surround themselves with competent advisors, such as lawyers, tax advisors, and family members, to come up with a successful business legacy plan. Also, an important aspect of this business plan is for their children to work in the business, and the family succession has been well received by the business stakeholders since they see continuity and fresh blood with new ideas. The decision to create and implement family business succession for these entrepreneurs is the fact that they own 100% of the company shares and want to keep business ownership within the family. Also, they feel responsible and want to protect the well-being of all their employees and respect their hopes and dreams, which are based on the success of the business. They also believe that inheriting the family business is not a property right, but a responsibility. These business owners also believe that the most important issues are how to train and educate children born in wealth, and being careful how not to spoil them by helping them develop strong self-esteem, good values, and reasonable hunger. Also, a bond that holds the family together is being transparent, generous, and letting each child be what he or she dreams to be, supporting family members and providing a safe place to deal with personal and business conflicts, and learning from mistakes. There are many different legacy models, but the most important consideration is to create a legacy model that works for your family. Therefore, having a clear understanding of how to address potentially contentious issues and having a mechanism in place to allocate decision rights and responsibilities among the family members are critically important to sustain its success and preserve the business legacy for generations to come. One thing that I found most interesting about these business owners is that they and the members of their families believe that they are only keepers of the tangible wealth and intangible goodwill created by their business, and that it is their responsibility to preserve, maintain, and make the company grow until they pass the family business to the next generation. Pablo, a Harvard Business School OPM 32 graduate and a successful business owner in Argentina, believes that they are not business owners, but the momentary keepers of planetary jewels. This understanding of property and businesses creates a smooth business succession, and the key to family business legacy is the family values and the education of the next generation. To create a clear vision for the business planning and continued success of the company, the business owner must reflect on the past, look at the present, and visualize the future to create an inspiring vision for the company. This vision will be a roadmap for its management, employees, and family members to actively participate and execute the business succession plan. It takes a team of many individuals to create and achieve a shared vision. The company's vision creates a beginning point and a destination. The business plan sets the goals, objectives, and the strategies and tactics to achieve them. You must recruit the best leaders, managers, and employees that share the same passion and desire to be the best. Leadership identifies the best managers and then invests in training those with drive and potential. For many business owners, operating their business day to day is time-consuming and retirement seems distant. However, establishing a sound family business succession plan is beneficial and necessary, and it requires careful preparation. Business owners seeking a smooth and equitable transition of their interests should seek competent and experienced advisors to help with the business for transition and create and help implement strategies to maximize the benefits and minimize both business and personal taxes. Some of the steps that a business owner needs to consider in transitioning out include evaluating the current marketplace and what is happening in the community, throughout the country, and even around the world that might impact a future sale or continuity of the business. It is important to determine the current growth of the business, changes in technology, and changes in the industry overall. Creating a family business legacy plan that is in alignment with the business owner's values is not easy, but once you decide to proceed, is relatively easy if you surround yourself with financial, business, and tax advisors to guide you and avail yourself with alternatives based on your individual situation. While some business owners decide to provide continuity to the family business, others may decide to sell their family business. Some of my clients have sold the company through an employee stock ownership plan, ESOP. An ESOP can be used to create a market for your shares and provide some tax benefits. Whichever decision you make about your business succession plan, it is critically important to hire an experienced business appraiser to conduct an evaluation of your business and to make sure that there are no liens or encumbrances affecting the continued success of the business. This is a perfect time to review and organize incorporation documents, equity ownership records, and to have all financial statements up to date. The accuracy of the business financial statements will determine the business valuation. If you have family members involved in the business, it is important to get them involved and informed along your planning process. Ideally, the transition should be a gradual, multi-year process due to the complexity involved in most business transition plans. For example, if you think you may be ready to exit your business within the next 3 to 5 years, now is the time to start that process. While that time frame surprises some business owners, taking a long-term approach allows for a well-thought-out transition. As you build this transition team, it is important to identify one key advisor who can take a lead role in the process and coordinate efforts for a smoother transition. Although you may have specific goals for business growth and profitability, planning for various outcomes can help you be prepared for any contingency. Your financial models should contemplate several different contingencies, and your transition plan should be designed around more than one potential outcome. Transitioning a business can result in different tax ramifications for the business and its shareholders, depending on how the deal is structured. Here is Helene's example, one of my business owners in New York City, who after 30 years of running her business, thought about her next phase of her life and decided to get ready to transition her business in the next 2 to 3 years. Helene assembled a strong team of advisors, including her accountant, tax advisor, and family members to provide advice for both her business and her family, which includes her husband and 2 sons. Helene knew that the transition of her business would have estate and tax implications, particularly given her family dynamics. Her older son had worked alongside her in the business for years, whereas her younger son was not as involved in the business. Helene consulted with her team of professionals, and she made sure that her husband and her 2 sons were part of the process. The first step for the team was to create estate planning documents, and secondly, to think and strategize the business transfer. These included a will, a revocable trust for Helene and her husband, and power of attorney and healthcare documentation. The next step in the estate plan was to incorporate leveraged gifts for their children and grandchildren in the form of grantor retained annuity trust, GRAT, a financial instrument used in estate planning to minimize taxes on large financial gifts to family members. This tax-efficient wealth planning strategy can be accomplished by transferring assets to the GRAT, but retaining the right to receive a series of annuity payments from the GRAT for a specified term of years. Each annuity payment is based on a percentage of the fair market value of the assets transferred to the grantor retained annuity trust, GRAT, determined at the time of transfer. The annuity payments would be satisfied by paying Helene and her husband the income earned by the assets owned by the GRAT, and if the income proved to be insufficient, by returning them a portion of those assets. Any property remaining in the GRAT, after all the periodic annuity payments had been made, would be distributed to their beneficiaries. After in-depth discussions about how to plan for and to mitigate estate tax implications, Helene and her husband purchased a second-to-die life insurance policy, which provides benefits to their heirs only after the last surviving spouse dies. In conjunction with this, they also executed an irrevocable life insurance trust, which names a trust and trustee as beneficiaries of the life insurance policy and includes rules set for the trust. This structure is designed to provide needed liquidity to pay estate taxes. Because Helene's team was in place, she was able to plan for the sale of her business years in advance. She worked with her advisors and took action to improve metrics on accounts receivable and her return on investment, making the business more attractive to potential buyers. Helene also assembled an excellent management team who would be willing and able to continue in their roles after the sale, helping to ensure continuity in the transition. Also, because Helene's sons were part of the management team, her business transition planning and estate planning often overlapped. By involving her family from the beginning, Helene ensured a smoother transition when the time comes for the sale of the business without risking family harmony. I hope these examples have given you estate planning ideas to enable you to create your family business legacy plan that is in alignment with your personal and business values.